No announcements this morning? Okay. So we're going to start with our usual start of the class test, but today I'm actually going to give you a couple of slides that are already in the lecture notes before I hit you with the test. Before I do that, is everybody now part of a group? Let me ask you a different question. Is anybody not in a group yet? Okay, look at each other. You got a group, right? There are about 4 people. You want to meet after? That might be a good place to start. If not, if you don't get into a group, make sure you get your name on the orphan list, and I will make sure that other groups notice that you're on that list. Second, does everybody have a company? This is actually a rhetorical question. You don't have to answer. That's just my guilt-inducing question. Pick a company. Don't wait for the perfect company to come along, because it will never come along. And remember, if you want to change companies, you can do that. So pick a company, start working on that company, because the worst thing you can do is not start at all, right? So pick any company for the moment. You can come back and put in a filler, right? So let's start today's session by going back to a construct I introduced during the corporate finance class. Remember the financial balance sheet? Okay? Well, you remember any balance sheet, right? There are assets on one side, debt and equity on the other. There are 2 ways you can approach valuation. The first is you can value just the equity in a business and focus just on the equity. The other is you can value the whole business. If you think, what's the difference? The best analogy I can offer is think of buying a house. Normally, when you buy a house, you take a mortgage to buy the house, right? I could ask you 2 questions about the house. I could ask you, what's the value of the equity you have in the house? Or I could ask you, what's the value of the house? And the only scenario where you can give me the same answer is if what's true? If you have no debt. So let's start by drawing that contrast, because the first decision you often have to make in valuation is, do you want to value just the equity, or do you want to value the whole business? If you decide to go the equity route, you got to wear blinders. You know what I mean by blinders? All you care about is equity. You look at the cash flows equity investors get out of the business, which is cash flows left over after debt payments, and you discount those cash flows back at the rate of return that equity investors need to make given the risk of the equity, which of course in corporate finance is the cost of equity. So when you take an equity view of a company, you're focused on cash flows to equity, you discounted the cost of equity, you get a value of equity. Now, if you take a very strict view of the world and you think about being an equity investor in a publicly traded company, what's the only cash flow that you get as an equity investor that's tangible that you get to see? Dividends, right? The dividend discount model is a special case of an equity valuation model. The problem with the dividend discount model is you're trusting managers. Trusting managers in what sense? Trusting them to pay out what they can afford to pay out, not more, not less. But if you don't trust managers to pay out what they can afford to, then it's due diligence on your part to say, hey, I know what the dividend is at Google, but I don't think that's the right cash flow to me as an equity investor. You estimate potential dividend. Sounds fancy, but that's the cash flow left over after you've met every conceivable need and debt payments. That, of course, is what we call the free cash flow to equity. It's potential dividends. Equity valuation, you care about cash flows to equity, you discounted the cost of equity, you have a value of equity. Here's the other way you can approach valuation. Rather than focusing on just the equity investors, you look at the other claim holders in the company. You know what I mean by claim holders? There are 2 ways I can raise capital. I can go to equity investors and say, give me equity and give you residual cash flows, or I can borrow money from you and make interest payments and principal payments. Collectively, both groups get cash flows from the business. The collective cash flow that lenders and equity investors get out of a business is the cash flow to the entire firm. It's a pre-debt cash flow. Why pre-debt? Because lenders now are not outsiders, they're insiders. I can look at the collective cash flow you get as a business and discount that cash flow back at a weighted average of what the equity investors want, which is the cost of equity, and what lenders want, which is the cost of debt, which is a fancy way of saying cost of capital. Cash flows to the business discounted back at the cost of capital is the value of the entire business. First principle in valuation, do not mismatch cash flows and discount rates. You know what I mean by mismatch? If you have cash flows to equity, don't be messing with the cost of capital. If you have cash flows to business, don't be messing with the cost of equity. I know I've been dumping on bankers for the last 2 sessions. Why stop now? So I'm going to show you a set of cash flows from an actual banking valuation. This is not a fairness opinion. This was actually a valuation backing a transaction. Let me give you some history of where I got these numbers. This was actually a company called Kennecott. It's a copper mining company that in the late 70s was forced to divest itself of a subsidiary called Peabody Coal. Because of antitrust laws, they said for whatever reason you can't own a coal mining company. So this was a company that had to sell off its coal mining subsidiary, and it got $600 million in cash in return for the sale. You're saying, what's the big deal? It was a $3 billion company that now had $600 million in cash, which it now viewed as a potential problem. What's the problem of having lots of cash as a small company? What were they afraid of? That somebody would take them over. So what's the most sensible way to get rid of cash you don't have a use for? Don't think like a banker. The most sensible way to get rid of cash you don't have a use for is give it back to the people who own your company, right? That thought never even crossed their minds. They said, what would they do with that money? Stupid things like pay bills, pay off the house mortgage. We can't have that. What's the stupidest way to get rid of cash? Now you can give me the answer. Buy somebody and buy somebody fast. So here's what Kennecott did. They went to First Boston. At that time, one of the leading M&A banks on the street. And they said, we have $600 million in cash and we need to do a deal really fast. Can you find us a target? Now this is like walking into Bloomingdale's with $5,000 of cash in your hand, waving it around at a salesperson. Can you help me spend this money? Or why don't you try a used car dealership? That'll be even quicker. And of course, First Boston found them the perfect target. A company called Carborundum, a company that manufactured abrasives. And by amazing coincidence, this company was available to be bought at exactly the amount of cash that Kennecott had on its balance sheet. Don't ask me how these amazing things happen. So they come back and they said, this is the company to buy. It's a great deal. So far, it looks like any M&A deal. You're saying everybody's got to make money some way. So what's the big deal? So this deal would have gone into history like any other deal, but it had the unfortunate problem of being picked as a Harvard case study. Not to illustrate valuation issues, but every Harvard case is a strategic case. So they put this in as a strategic case, and you were supposed to draw your usual strategic diagrams and tell me whether Kennecott was a good fit. But they gave away the game. I don't think the case writer intended it, but as one of the exhibits, they actually put in the exhibit that First Boston developed as cash flows for Kennecott to back the $660 million price. I latched onto that page. I didn't care about the rest of the case. I don't care about strategic stuff anyway. So I said, okay, let me focus on these cash flows. So I'm going to show you the cash flows. I'll lead you through. And then I'm going to ask you a very simple question. If you can nail this, you got M&A nailed. So I'll go through the cash flows for Carborundum. Here's how they estimated the cash flows. They took revenues and they subtracted out expenses. They came up with operating income. They subtracted out interest expenses. They came up with net income. They subtracted out capex and working capital and debt payments to come up with cash flows. I went through that fairly fast, but think about all the items I hit along the way. So there's the cash flow that they have from the acquisition, right? That net cash flow. So here's the question I have for you. I have cash flows. To do a DCF, I need a D, right? So I'm going to give you 6 choices for the discount rate. And I'll tell you up front, only one of these is right. There's no hedging around this answer. And I'd like you to tell me what the right discount rate for these cash flows is. First, there are 2 companies, right? There's Kennecott, the acquirer, Carborundum, the target. I have a cost of equity and a cost of capital for each of them. After the merger, there's going to be a combined company. Let's call it Kenna Carborundum. And they're the combined company's cost of equity and capital. So I have 6 numbers, 3 costs of equity and 3 costs of capital. Let's start by reducing our choices. Should I be using, remember the way I described how they computed cash flows, that they took revenue, subtracted operating income, subtracted interest expenses, subtracted reinvestment and debt payments to come up with cash flows. Given the way I've computed cash flows, should I be looking at the cost of equity as my discount rate or the cost of capital? Somebody said equity. Tell me who if somebody picked equity. Tell me why equity. What is it about equity?
Because it's cash flows that are available to the shareholders.
And what was it that I did that made it available to the shareholders? I removed interest expense. The minute I do that, I'm stuck. These are called levered cash flows. They're cash flows to equity. So the cost of capital. So draw a red line through the cost of capital numbers. 3 of the 6 are gone. That reduces your choices. Now let me ask you the second question. Is everybody comfortable with that? Cost of capital would have been okay if I looked at pre-debt cash flows. If I used operating income, netted taxes, reinvestment. The minute I subtract our debt cash flows or cash inflows from debt or bring in cash inflows from debt, I have an equity cash flow. Now let me ask you the second question. Whose cost of equity should I use? Should I use Kennecott's cost of equity, because after all they're coming up with the money? Should I use Carborundum's cost of equity, or should I use a combined company's cost of equity? So let me do a show of hands. How many of you think I should use the acquiring company's cost of equity? Come on, you can't bring your hand down just because you don't see other hands go up. Eh? I'll put you on the spot. I'm sorry to make you the spot person. Give me the rationale.
Well, if I think of it as like project finance.
Okay, let's pause right there. So basically you're saying it's a project. I agree with you. So far you're right. It's a big project. Go on. The cost of the discount rate for a project should be what?
What my hurdle rate for?
Hurdle rate for? Not the company, but the project. Corporate Finance 101. It's not the entity taking the investment that determines the risk, it's what you're investing in. You're absolutely right, it's a project, but it's a project that it's in a very different business. I cannot use Kennecott's cost of equity, because if I did that, every company that I look at that's safe, that's riskier than me, will look cheap to me, because I'm using my discount rate. So you can never ever use the acquiring company's cost of equity. You know how many M&A valuations I see where the acquiring company's cost of equity and capital are used as discount rates? Half of all M&A valuations are flawed right off the beginning. We don't even have to debate discount rates. You've used the wrong company's discount rate. You're saying, why not the blended number? It still doesn't make any sense. If I'm a safe company taking a risky project, I can do as many dances as I want, but that project is a risky project. It's the target company's cost of equity that I should be using on these cash flows. What do you think First Boston used as their discount rate? What's the worst possible choice you could make? Wrong company, wrong discount rate. They used Kennecott's cost of capital. You're saying, what's the big deal? Well, here's the big deal. Kennecott's cost of capital is 10.5%. Carborundum's cost of equity is 16.5%. So instead of discounting at 16.5%, they discounted at 10.5%. That's how they got the $660 million. If I took their cash flows, didn't even contest a single assumption, and used the right discount rate, I'd have got $400 million. What have you just done? You've induced your client, in this case Kennecott, to pay $660 million for a business that you've actually valued at $400 million. For this, I'm paying you advisory fees. This is not just difference of assumption, just plain wrong. Yep.
I hope this is on base here.
Go on.
The risk for one of these targets might be its ability to access capital markets at scale as it builds its business.
Okay, let's take Tesla and Solar City. Actually, let's take that's perfect example, right? One of the justifications I heard for why Tesla should be willing to pay more for Solar City is Solar City standing alone is going to have trouble making its debt payments. Let's assume, and Tesla is no hero in this process, it's not like they are looking, but let's say Tesla was a solid company with a AAA rating. It's not, but let's say it is. Let's say that Tesla buys Solar City, and because Solar City now has access to the capital, it can survive. Let me ask you a question. Why should Tesla shareholders pay a premium to Solar City shareholders for something that they had absolutely no role in creating? I'm not saying there's no value created. It's not their value creation. It's your value creation. You are a safe company. You've earned that high rating. Why should you go around endowing other companies with that strength when you're the one bringing it to the table? So if you're creating value, good. Create it for your shareholders. But if you pay it as a premium, which is what you're going to do in this valuation, because the minute you put into value, remember, you're going to pay a price.
So what we're looking at, though, is a timeline of valuation, right?
No, you're looking at... No, that's not what we're looking at. We're looking at, is the valuation becoming what you will pay, or is the valuation what you will get? This becomes your basis for payment, right? So everything you put in here, you now are going to be willing to pay to the target company shareholders. What's left for you?
Depends what that price is, right?
But in this case, so once you put up the value...
Tesla and Solar City case is one that's
Okay.
covered here. I'm just
Okay,
thinking about this in terms of the actual...
that's perfectly okay, but if you're going to negotiate the price, I would argue if you're the acquiring company's banker, none of this. This is not synergy where two sides contribute. This is a one-sided game. You are bringing in all the good stuff. Why are you sharing it with those guys?
Well, you might think that you're still getting a price that is less than what it would be if it could access the capital markets, build its business
But
in
if-
a year, 2 years, 3 years.
But if what you're bringing in your valuation is that addition in value, it's all yours. It's not coming from some improvement in operations.
A lower price than what you're otherwise expecting would be the price.
No, but it's still, if that is, there's got to be other factors. There's got to be some other benefits you're getting, because if this is the only thing you're bringing is your credit worthiness to the game, this is a game you can never win. You're giving away stuff you shouldn't. In fact, we'll come back and talk about this, specifically in the context of acquisition valuation, because if the only thing you're bringing to the game is I'm credit worthy, you're not, it's a bad reason for doing acquisitions.
Because if you look at the cost of capital from the equity markets in a certain period, it might be higher than it would be in other periods because of how the equity markets move. So wouldn't you think that there is sort of like a
None.
arbitrage?
Don't play, I'll tell you up front, if you're playing discount rate games on acquisitions, it's a losing game. Absolutely. If you're going to give me a reason for acquisitions, make it a cash flow reason. The more you dance around discount rates, the more I'm going to tell you you cannot win this game. Okay? We'll come back and talk about why. I mean, I can see where you're going with discount rate. No, it's not. It shouldn't be. That's what I'm saying. If the driver for your acquisition is some game you're playing in the discount rate, you're playing the wrong game. Let's we'll come back to it, as I said, with acquisition valuation, but I think it's the wrong game. Right? So in this case, all you need to do is replace the discount rate with the appropriate number, and all of a sudden, your good acquisitions become a bad one. Now, these bankers should have been punished for this deal, right? You know who ran First Boston in the late 1970s when this deal was done? Two legendary names. Bruce Wasserstein and Joe Perella. If you follow deal making, these are in the deal making hall of fame, or shame, depending on what you want to name it. You know how they were punished? In the mid-80s, they separated from First Boston and created a boutique investment bank. That's a kind of scary word for me, boutique investment bank, called Wasserstein Perella. And we talked about Wasserstein Perella in the last session, right? Single-handedly, this outfit brought in the practice of valuation 6 notches. And you know how they were punished for all those bad practices? In the early 1990s, Dresner bought Wasserstein Perella for $2 billion. And you know what they were paying for? And I can't make up this stuff. for their valuation expertise. This is a game. The more screwed up your valuations are, the faster you rise to the top. It's a reminder again, when you see deal valuations, don't look at the name on the valuation and don't fool yourself that Goldman did it, therefore it must be okay. Check the numbers. You'd be amazed at how many first level mistakes creep into your valuations. So let's set this aside. Let's go back, and as I said, we'll come back and talk about acquisition valuation, because there are ways of creating value from acquisitions, but it's almost always going to be in the cash flows. Discount rate value creation is really tough to do in acquisitions because you're a public company. If you're a private business, the game becomes much more expensive, but as a public company, it becomes very difficult to play that game. So let me move forward to slide 8, because I just did slides 6 and 7. So let's assume you decide to value a business and use it to get to the value of equity, which is what I think 85% of all discounted cash flow valuations use. Cash flows to business, discount back at the cost of capital, come up with the value for the business, then subtract out debt to get to the value of equity. So here's my first question. It's a mechanical question, and many of you might have done DCF somewhere along the way. So you've come up with the value of the firm by discounting cash flows of the firm back at the cost of capital. To get to equity value, which of the following should I be doing? Subtracting out the value of all long-term debt, subtracting out the value of all debt, subtracting out the value of whatever I call debt when I did my cost of capital, or subtracting out all liabilities on the balance sheet, which would include things like accounts payable, current liabilities, etc. Long-term debt, total debt, whatever I call debt in my cost of capital, or all liabilities. Anybody want to try? What do you think it is? C, the debt that you have. And what might you include in your, so what other than all interest-bearing debt would you have? What else would you have in there? But what might show up as debt in your cost of capital that would not have shown up when you looked at debt on the balance sheet? Leases, right? So when you talk about leases, this is why leases play out in different parts of the valuation. So whatever you chose to call debt in your cost of capital, and that included leases, you got to include leases. But what you can't do is include leases when you do debt for the cost of capital. When you subtract our debt, forget about leases. Or not include leases in your cost of capital, and magically you cannot dance back and forth between different definitions of debt. So once you've nailed down your definition of debt, stick with it all the way through. If you have no idea what I'm talking about with leases, we'll come back and talk about it much more explicitly about how to convert leases to debt and why you should be treating it as debt. Now let me ask you the final question. There are two ways you can value the equity in your business, right? One is to take cash flows to equity, discount the cost of equity, get a value of equity. The other is to take the cash flows of the firm, discount the cost of capital, and subtract our debt to get a value of the equity in the same firm. Should I get the same value for equity using both approaches? Would you like to get the same value? Let's get that out of the way. I would, and here's why. Let's say with an equity approach, I come up with the conclusion that my stock is worth 12, and by using the firm approach, I come up with a value for my equity of 8, and the stock is trading at 10. Can you see the recommendation I would put out as an analyst? When I use the equity approach, the stock looks cheap. When I look the firm approach, it looks expensive. It's not going to fly very far. So you'd like to get the same value for the equity. But it's actually one of the toughest challenges in valuation, is to take a company and actually value it using the equity approach and the firm approach and see if you can get the same value. I don't do that many independent studies anymore, but I remember about 3 or 4 years ago, perhaps even longer, somebody in this class decided that they were going to take one of these one credit independent studies, and they decided this was a slam dunk. It would be so easy to do. They proved that the value of equity. They came to me and they'd picked a company and they said, can I do this as my independent study? And you could tell by the way they were describing it that they thought this was going to be like a 3 to 6 hour project for one credit. I knew exactly what they were getting into. I said, oh yeah, I think it's a good idea. 14 weeks later, the guy was still struggling on it. Good news is, by the 15th week, the last week of the semester, but there were so many implicit, in fact, the good news was he understood the assumptions we make in valuation that we often don't state. When you use cost of capital, there are all these implicit assumptions you make you don't even think about. He was forced to think about them explicitly. You're saying, thank God I'm not that guy. Remember I told you there's a weekly challenge every week? The first week's challenge is going to go out this week. It's going to be a very simple example of a company where I'm going to ask you to value the equity of the company using cash flows to equity and cost of equity. And I'm going to ask you to value the company using the more traditional cash flow to the firm and the cost of capital. And I'll give away what you're going to find up front. You're going to get different values for the equity using the two approaches. And I'm going to ask you, why do you think that's happening? And how do you make it go away? Give it a shot. Because if you can work through that, you'll be able to deal with this question of why do we sometimes get different answers using an equity approach as opposed to valuing the whole firm and subtracting out debt. No wonder it's not moving. So let me give you a very simple illustration. And I'll tell you up front that I'm cheating in this example to get the easy answer I'm going to get. So that's what you're going to struggle with your weekly challenge. So I'm going to give you a company, and for the moment I know we haven't talked about cash flows, we haven't talked about how to come up with cost of equity or capital. So take the numbers as given. I've taken a company, I've projected out the cash flows for the next 5 years and a terminal value at the end of the 5th year. So those are my cash flows to equity, and those are my cash flows to the firm. The cost of equity for this company is 13.625%. Let's not go there as to how I got it. Some numbers went in there. The cost of capital, the cost of borrowing money for this firm long term is 10%. But it gets an interest expense tax reduction, so the tax rate is 50%. So after tax, it costs only 5%. The current market value of equity for this firm is $1,073 million. The current market value of debt is $800 million. So you got the cash flows. I've given you the cost of equity, the cost of debt, and the market values of the two. So you ready? Let's try valuing this company. First, I'm going to try to do the equity approach, where you take cash flows to equity. So in the previous page, you can see the cash flows to equity, 50 million in year 1, 60 in year 2, etc. Discount them at the cost of equity, 13.625%, and I get a present value of $1,073 million. The value of equity is $1,073 million. So this stock is correctly priced. The estimated value that I get for the equity is equal to the market value. Then I try the cost of capital. I take the cost of equity weighted by the proportion of equity using market value weights, which is what you're supposed to do in valuation. And I take the after-tax cost of debt, 5% weighted by the amount of debt. I get a cost of capital of 9.94%. So I'm ready, right? I have cash flow firm. I discount back at the cost of capital. What I get as a present value is $1,873 million. I subtract out my debt, which is $800 million. Magic. I get exactly the same value for the equity using the equity approach and the firm approach. As I said, I cheated in this example. There's something I've done that allowed me to get this answer. I'll let you start thinking about what that something is, because that's going to be at the core of the weekly challenge. Because once you can crack that code, you're going to say, that's why you're getting the same answer. If that had not been true, your answers would have diverged. Yes? Well, in this case, you can treat this as net debt. If there's cash, it'll add on to both. So basically, cash is like this loose end you can always tie up. So if there's cash, just it'll be a plus on both or a minus on both. So it shouldn't make a difference your overall analysis. Now, yes, go ahead. No, the cost of equity is 13.625%. The cost of capital is 9.94%. Right? So the cost of capital is 9.94%. The cost of equity is up there. Right? So the two are different, and they have to be. Now, otherwise, the whole thing will blow up on you. Now, here are all the things you should not be doing. So put a big X on this page, because on your quiz, I don't want you to end up on this page and start doing everything on this page, because you're in a hurry. You say, let's do it exactly. So here are the things that will not work for you. If you mismatch your cash flows, all is lost. I don't care how much work you put into your cost of equity, How many hours you spend estimating the cash flows, mismatching cash flows is going to cause your valuation to blow up. Let's see by how much. If I took cash flows to equity at the cost of capital, I come up with 1,248 million. I'm going to find my stock to be undervalued by 175 million, but it's really not undervalued. It's because I screwed up. That's the Kennecott screw up, right? You took cash flows to equity, discounted the cost of capital. If you take the cost of cash flow to the firm and discount at the cost of equity, you get the reverse problem. You've discounted the cash flow to the firm at too high a rate, the cost of equity. What you get as a present value is 1,613. You subtract out the debt, you come up with 813 million. Now, the problem is when you're taking cash flow to the firm and discounting the cost of equity, you're probably so confused about what you're valuing in the first place that you might forget to subtract our debt. So that's a third problem, where you've somewhere in the middle of your valuation, you don't even remember what you're valuing because you kept tabs on the numbers at different points in time. Check discounted cash flow valuations for consistency. We're going to introduce two other tests for consistency, but this is what I call claim holder consistency. Are the cash flows being estimated to the equity of the firm? Is the discount rate measured accordingly? So what I'd like to do is set up the big picture of how we're going to approach the input process. Because if you break down discounted cash flow valuation, there are 5 steps we're going to go through. We're going to start off talking about discount rates. And I'll tell you up front, we spend far too much time talking about discount rates in this class and in every other class, but in a sense it's a, you know why we spend so much time talking about discount rates? Because that's where we're comfortable. We can get specific and we can draw on models and theories and not have to estimate things. But we're going to start with discount rates. We're going to talk about what goes into cost of equity, what goes into cost of capital. This should be partial review of what you did in corporate finance, but I will assume you don't remember much of what we did in corporate finance and kind of make sure that we kind of hit at least the first principles. Second step in the process, estimate, before you get too ambitious about the future, estimate what the company did last year. What were the earnings? That should be easy, right? You're going to see very quickly that even answering that very basic question, how much did my company make last year, is going to give us headaches. Because along the way we have to deal with accounting inconsistencies. What are operating expenses? What are capital expenses? What are financial expenses? Third step, and this is where the rubber meets the road, where you start to get uncomfortable. I'm going to ask you about the future. And your first reaction is, I don't know. I don't either. Nobody does. It's okay. Make your best estimates. We're going to talk about growth and future earnings and future cash flows. And then I'm going to ask you, when will your company become a stable growth company? Because remember, for closure in my valuation, I can't keep projecting cash flows forever. So I've got to come up with that giant in the room, the elephant that I don't want to deal with, the terminal value. And finally, along this process, I have to decide which discounted cash flow model is right for my company. Notice how I phrase that. Not right for every company, but right for my company. Half of valuation, as I said, is making the right choices about what cash flows to discount, how long to let growth continue, and those answers are specific to your company. So if you strip down every discounted cash flow model to basics, they share some common characteristics. So what I'm going to do is I'm going to take discounted cash flow valuation, show it to you as a picture, and show you what the different versions of the model share in common. So you look at any discounted cash flow model, here's what it looks like. You have your base year numbers, and those cash flows that I get from my base year can either be pre-debt cash flows, in which case they're cash flows to firm, or post-debt cash flows, in which case they're cash flows to equity. I need a growth for the future, and if I'm looking at firm cash flows, that growth has to be growth in operating income. Whereas if I'm looking at equity cash flows, the growth rate has to be in net income. Again, it might seem like I'm dancing between two numbers, but you're going to see with companies how different those two can be. The discount rate I need for these cash flows, if I'm looking at cash flows before debt payments, will be the cost of capital. After debt payments will be the cost of equity. And in every single one of these models, the closure is estimated by assuming that at some point in time my company will get into stable growth, a growth rate it can sustain forever, and I get a terminal value. That's it. Cash flows, discount rate, growth, and terminal value. Let me lay out very broadly the 3 different sets of DCF models we're going to start with. So let's start with the oldest one. In 1938, John Williams unveiled the dividend discount model. Basically, that's the first time a discounted cash flow model was described on paper. He said the value of a stock is the present value of the expected dividends. Oldest discounted cash flow model around. There the cash flows are the dividends that are actually paid out. So in a sense, you're dependent on managers paying out what they can afford to. It is an equity cash flow. So the growth you're looking at when you're looking at dividends is growth in equity income and the payout that comes from that equity income. The discount rate you're using is a cost of equity. And what you get when you get to that terminal point is when your dividends start to grow at a constant rate forever. So in the dividend discount model, cash flows are dividends, discount rate is cost of equity, maturity is when dividends start to grow at a constant rate forever. In a free cash flow to equity model, all you do is replace dividends with potential dividends. That's what free cash flows to equity are. Cash flows left over after debt payments and reinvestment needs. The discount rate is still the cost of equity. It's still an equity cash flow. And you can put closure when you're willing to assume that your free cash flows to equity start to grow at a constant rate forever. Tougher than dividend growing at this, because now you have to talk about capex and depreciation and working capital and debt payments all settling into steady state. In a free cash flow to the firm model, your definition of cash flow shifts from post-debt cash flows, which is what free cash flow to equity is, to pre-debt cash flows. So instead of using net income as my starting point, I start with operating income. And debt payments don't even enter the picture. That free cash flow is called the free cash flow to the firm, or as some people prefer to call it, an unlevered cash flow. The discount rate you apply on those cash flows is the cost of capital. And you put closure when those cash flows start to grow at a constant rate forever. So while we go through these three models, you'll be tempted to think of these as three separate models, but think of them as three versions of a discounted cash flow model, each internally consistent based on the choice you made up front. So almost every valuation you're going to see in this class is going to show up as a picture, and in that picture, you're going to see me focus on what I'm valuing in that particular company. So if I'm looking at a dividend discount model, this is what my valuation picture is going to look like. It's going to start with net income and payout to get the dividends. My cash flows for the future will be expected dividends. My terminal value will be the present value of dividends forever, and I'll discount them all back at the cost of equity, and what I get as a present value will be the value of equity in a company. That's a dividend discount model. Everything is focused on dividends. Nothing to mop up. You don't add cash, you don't subtract our debt. Do nothing. You're done when you get the present value. With a free cash flow to equity model, things get a little messier, because now I'm computing the potential dividends, and I have some choices to make. I prefer, when I do free cash flow to equity, to look at free cash flow to equity only from operating assets. What does that mean? I separate the interest income from cash and keep it apart from the valuation. And we'll talk about why. I discount my free cash flows to equity at the cost of equity, and I come up with the value of equity. But remember, that value of equity is the value of equity in my operating assets. And because I removed the interest income from cash from my calculations, I now say, look, I haven't counted cash yet. I'm going to add cash. I get a value of equity. Slightly messier than a dividend discount model, because now I'm stepping in and estimating the cash flows. Don't worry, we'll go through each of these specific items in detail. So for the moment, if it's all flying by you as terms, focus on the big picture. We're focusing on cash flows to equity, cost of equity, value of equity. The final version of the model, I look at cash flows to the firm. Pre-debt cash flows. Notice I start with after-tax operating income, not net income. I subtract out reinvestment just like I did to get to cash flow to equity, but I don't have interest payments, no debt payments are in there. I have free cash flows of the firm. I have a terminal value based on those free cash flows of the firm growing at a constant rate forever. I discount them all back at the cost of capital. And that's when my job really begins, because what I valued are the operating assets of the company. Why? Because my free cash flow to the firm is based on operating income. And because it's based on operating income, any item that is not in my operating income has not been valued yet. Cash obviously has not been valued. What else hasn't been valued? If I'm looking at a company like Yahoo, if I take free cash flow of the firm, discounted the cost of capital, come up with the value for the firm, I'm going to get close to zero, if I'm lucky. I mean, especially with Verizon take. But what have I not valued in the case of Yahoo? What are Yahoo's two biggest assets? 35% of Yahoo Japan and 14% of Alibaba. Why haven't I valued them? Because they're treated as minority cross holdings, and the income from those cross holdings show up below my operating income line. I can't abandon them. So this is the mopping up process where you got to bring in every other asset that has not been counted yet, cash, cross holdings. You subtract out debt, you come up with the value of equity. So we're going to spend a lot of time on that mopping up process because so much can go wrong in getting from that present value to the value of the firm. So what I'm going to start with today is the discount rate piece of the equation. Do discount rates matter in discounted cash flow valuations? Obviously, it's discounted cash flow valuation. But having said that, they don't matter as much as you think they do. And I'll give you some basis for this as we go through. But you do need a discount rate. Now, before we get into the mechanics of discount rates, remember we talked about consistency, cash flow to equity, cost of equity, cash flow to the firm, cost of capital. Let me add two more pieces to that consistency puzzle. The first is, you tell me what currency your cash flows are in, your discount rate has to be in the same currency. You do your cash flows in US dollars, your discount rate has to be in US dollars. You do your cash flows in Argentine pesos, your discount rate has to be in Argentine pesos. And we're going to see very quickly what happens when you mismatch. Second, if you decide to do your analysis in real terms, you know what I mean by real terms? You decide to take inflation out of your cash flows. Latin America, for a long time, this was the preferred way in which capital budgeting and valuation was done, is let's not deal with inflation because it's too messy. You do everything in real terms, your discount rate has to be a real discount rate. So in addition to making sure you got the claim holders matched up, make sure you got currencies matched up, and make sure that you're not messing up nominal and real in the same valuation. Okay. So let's think about what we want to bring into discount rates. Okay. As I said, in discounted cash flow valuation, the discount rate is the vehicle for you to reflect risk, right? That's the one thing everybody agrees on. Yes, of course it should. But this is where the disagreements begin. What risk should I reflect, and how do I reflect it? So here's the way I think about what goes into discount rate. For my risk-adjusted cost of equity, I need a riskless rate to start with. Without a riskless rate, I'm stuck. I can't do any of the other analyses without it. So we're going to start with a riskless rate. That risk-free rate is going to depend on what currency I just decide to do the valuation. And obviously, when I do it in Argentine pesos, my risk-free rate might be 15 or 20%. If I do it in Venezuelan bolivar, it might be 5,000%. In US dollars, it might be 2%. In Swiss francs, it might be minus 0.5%. We're going to wrestle with what do we do with that. It's kind of mind-boggling. But we're going to have to start with the risk-free rate. Second, I need a measure of how risky this company that I'm investing in is relative to the average company. Do you see why I phrase it that way and say, what's your beta? Because beta, you've already made a choice. If that's how I measure risk. We need a measure of relative risk. So if you don't like the beta, use some other measure of risk, but you need a measure of relative risk. Some companies are riskier than others. That's stating the obvious, might as well state it. And finally, I need a risk premium that you would charge for investing in the average risk stock. Implicit in that statement are so many judgment calls, right? What's average for you? How risk averse are you? So we're going to have to wrestle with risk-free rates, measures of relative risk, and risk premiums along the way to get to a cost of equity. But while we're doing that, we have to stop and ask, what exactly is risk? So I'm going to start off with a very simple proposition. When you sit down to value a company, any company, and so already if you've picked a company, think about your company. And I'll think of two companies. In fact, tomorrow I'm supposed to be in Santiago, and day after tomorrow in Buenos Aires. And I have a Chilean company I'm valuing tomorrow, LATAM, which is one of the leading Latin American airlines, who's combining TAM with land. So basically, you combine two airlines where you get a disastrous big airline. But so we'll talk about that. And day after tomorrow, I'm going to be valuing a company called San Miguel, which is an Argentine lemon, orange, tangerine producing company. So basically, it's draws on one of Argentina's strengths, which is lemons grow out of nothing. So I'll use my two companies as illustrative examples. You think of your company, because when you sit down to value a company, Of course you're going to have lots of uncertainties. One of the things I suggest people do is write out everything you're uncertain about. The list will get really long, right? I'm uncertain about this. I'm uncertain. Oh, I'm really uncertain about this. Then start putting the uncertainties you face into buckets. What kind of buckets? First ask yourself, is this uncertainty estimation uncertainty or economic uncertainty? With San Miguel, I couldn't even find out how many shares were outstanding in this company. It took me like 6 hours of research to discover the actual number of shares. This shouldn't be. But that's estimation uncertainty. If I do my homework enough, I can make it go away. You know what economic uncertainty is? San Miguel is a Argentine company, right? No amount of Excel spreadsheeting is going to make that go away. What if the questioners come back tomorrow? And I'm not going to be there day after. No. But if the government changed next week, the entire game will change. There's what I call this karmic point in valuation. You know what karma is, right? At some point you can say, there's nothing I can do about that. I'm going to move on. Day after tomorrow, when I value San Miguel, I will wager that 90% of the questions I get will not be about the company. They'll be about, now, what do you think about Argentina? What's inflation going to be next year? And my response is, I don't know, and I can't do much about it. So here's my valuation given that economic uncertainty. Economic uncertainty is out of your control. Don't try to control it. Don't try to bring it under your control. You can't do it. It's just going to frustrate you. 90% of what you face in valuation is economic uncertainty. That's why spending hours or days, because the first response you have to answer, let me go collect more information. Let me do a Google search on this. Don't do it. It'll just make you more frustrated if the underlying uncertainty is economic uncertainty. Second, and this is related to the first one, the uncertainty can be micro uncertainty or macro uncertainty. Last week I was asked to come on Bloomberg to talk about Snapchat. I got preempted because Donald Trump had that Mexico thing at the same time, so they kicked me off saying you're not as big a draw as the Donald, which I accept, right? So, but if I were asked to value Snapchat, this is a young company with about $356 million in revenues, which is expected to have revenues of about $1 billion. But when I value Snapchat, a lot of the uncertainty I face is company specific, right? Which is, will people put advertising on the company? That's what you call micro uncertainty. Uncertainty that's arising from the company, its business model, from whether the model will work. Macro uncertainty comes from the outside. Like there's going to be a Federal Open Market Committee meeting November 9th, right? And already people are freaking out. They say, how do I bring it into my valuation? Macro uncertainty is uncertainty that's coming from the outside. And the reason you want to break down your uncertainty in micro and macro is, guess which type shows up in your discount rate? You've got a 50-50 shot. Is it micro or is it macro? It's only macro uncertainty. You know why? Because micro uncertainties cut both ways. I can be over optimistic about my first company I value. I might be pessimistic about the second one. But micro uncertainties average out. That's diversifiable risk. Macro uncertainties don't average out. I could buy 1,000 companies, and if something crazy happens on November 9th, or if a new government comes in Argentina, it's not going to help me that I'm a diversified investor. I'm still going to get slammed. Micro uncertainty or macro uncertainty. And here's the third type of uncertainty, and this is something worth thinking about. Uncertainty can be either continuous uncertainty or discrete uncertainty. Let me give you the simplest example that I have for this. Let's assume you're a US company with substantial British operations. As you probably know, the last few months the British pound has been all over the place, usually going down. Are you affected by the pound-dollar exchange rate? Well, absolutely, right? Every time it changes. How often are you affected? Every second of every day, right? Because it's a continuous risk. In contrast, let's say you're a company with, I don't know what country has fixed exchanges, Vietnam. Let's suppose you're a company with 30% of your revenues from Vietnam. And the currency is a fixed exchange rate. Right? So On a minute-by-minute basis, there's no risk, right? At least I don't perceive any risk because the exchange rate doesn't change, it doesn't change, it doesn't change, it doesn't change until it does change. There's a devaluation of 50%. That's discontinuous risk. Which one do you think is easier to deal with in valuation, continuous risk or discontinuous risk? Continuous risk is much easier. Every single risk measurement tool we have in finance is designed for continuous risk. That's why discrete risks kill you. Whether it's value at risk or betas or any other measure of risk, we're great at dealing with continuous risk. But anytime you get these big discrete risks, a nationalization, a distress, I mean, that's one of the problems in discounted cash flow valuation is how do you reflect distress? And distress, as we'll see, does not show up in discount rates because discount rates were not designed for that kind of risk. So we're going to talk about explicitly how do you deal with companies where the biggest risk you face is a discrete risk, that the company could be nationalized, it could go bankrupt, there could be a terrorism risk. Because those are the risks we're not that good at dealing with traditional discounted cash flow models. Because once you've broken things down into buckets, that's when you got to do almost a mindset change. Because when you sit down to value a company and ask you how risky is this company, it's natural to think about how much risk do you see in the company? It's not about you. It's not about you in the sense, no matter how much risk you see in the company, the way you should measure risk to put into a cost of equity is to ask a different question. What does the marginal investor in this company see as risk? Because in a sense, you're a price taker. You're saying, what difference does it make? Marginal investor, me, we're all the same thing. You're not. Because the people who set prices at the margin tend to be investors who own a lot of stock and trade that stock. They tend to be institutional investors, and you're going along for the ride. So whether you like it or not, the way we think about risk is we have to think about risk through the eyes of those investors. That's what we do when we use betas, right? We're not saying we're all diversified, we all hold a market portfolio. We're just saying that the people who set prices are diversified enough that they care only about the risk you cannot diversify away. So we're going to wrestle with that because sometimes that our assumption that the marginal investor is diversified is going to break down. Like when? Like day after tomorrow. When I value San Miguel, small Argentine company. Not exactly an institutional investor buy list, where the family might control 30%, of the float might be only 15% of the shares. I'm going to be on very thin ground arguing that this company is being priced by diversified investors. So we'll talk about what to do when that assumption breaks down. Because that's going to make a big difference into what risk we bring into the cost of equity and what risk we leave aside. This is not a risk and return model class, so I'm going to take everything we need to know about risk and return models, put on this page, and then move on. In the last 60 years in finance, actually 50 years, since 64 through now, we've gone through phases where we've come up with risk and return models. The oldest model, the one we spend the most time on still in offices, in consulting firms and banks, is the CAPM. In the CAPM, the cost of equity is the risk-free rate plus the beta. Beta becomes your measure of relative risk, and it captures all of the non-diversifiable risk in there, times the risk premium. From 1964 through 1978 was the only game in town. Late 70s, you saw the arbitrage pricing model, where instead of having one market risk factor and one beta, you allowed for multiple market risk factors, still in the same dimension as the CAPM and different betas. The only problem with the arbitrage pricing model is you never named those factors. There were statistical factors, factor 1, factor 2, factor 3, factor 4, factor 5. About 10 years later, you came up with models that tried to put macroeconomic names on these factors, interest rates and term structure, which are multi-factor models, where the cost of equity is the risk-free rate plus beta times the risk premium for each of these specified macro risk factors. And then towards the end of the 80s, early 90s, you saw proxy models where people basically gave up. They said, hey, this is tough to do. So let's see what the market's doing. And looking at companies that earned high returns on equity over the past and saying those companies must be riskier. So small cap companies, low price to book companies, these are proxy models. Every risk and return model you will see out there is either one of these or some melded version of the two. Like you'd see some people estimating cost of equity, taking risk-free rate plus beta times risk premium plus a small cap premium. That's a proxy model built on top of the CAPM. We'll come back and talk about why, if the entire discussion and evaluation becomes about this number, you've lost the game. But this is setting the table on the different choices. In every one of these models, you start with a risk-free rate. That's a given. In every one of these models, you need a beta. In the CAPM, you need one market beta. In the arbitrage pricing model and multi-factor models, you need multiple betas. And in every one of these models, that beta has to be multiplied by risk premium. So I'm going to kind of keep the focus on the CAPM, not because I think it's the only game in town, because whatever I say about beta and the risk premium in the CAPM, just multiply by 5. You decide to use the multi-factor model. Everything still flows. So every one of these models, the starting number is a risk-free rate. So that's where I want to start. What exactly is the risk-free rate? I told you this in corporate finance, but I'll tell you this again. When I did my MBA, I think we spent 1.5 minutes to 2 minutes on the risk-free rate. It's a long time ago. But I was told the risk-free rate is a US Treasury rate. Let's move on. Which showed you how dollar-centric MBA classes were then. And also this complete belief that if it's a US Treasury, it must be default-free. Those days are done. Because let's face it, if you can't estimate a cost of equity in Mexican pesos or Venezuelan bolivar, maybe not Venezuelan bolivar, let's take that off the equation because that might be too much for anybody to do. Nigerian naira, you can't do valuation because you've got to be able to move across different currencies. So let me start off with what we need for something to be risk-free. For an investment to be risk-free, you need to know exactly what you're going to make on that investment with certainty. Okay? Which means that the entity issuing the security can have zero default risk, none, and there can be no reinvestment risk. You know what I mean by reinvestment risk? If you have a cash flow in year 5, a 6-month T-bill is not risk-free because at the end of 6 months I've got to reinvest and reinvest again and reinvest again, so there is reinvestment risk. So if you lived in a purist world, to get to a risk-free rate for a cash flow, you'd have to tell me when the cash flow happens, what currency, and I would find you a nice zero coupon default-free bond with that maturity and you'd be done. That would be a pain in the neck and impossible to do in many currencies. But I'm going to draw 3 implications just from that definition. First is, if anybody asks you what the risk-free rate is, refuse to answer the question unless they specify over what time horizon. Because there is no one risk-free rate. Are you talking about the next 3 months, the next 6 months, the next year, the next 5 years, the next 10 years, the next 30 years? Refuse to answer unless they specify what currency. It's meaningless if you ask me, what's a risk-free rate? What, US dollars, Mexican pesos, euros? And if they ask you what's a global risk-free rate, just walk out of the room. There is no global risk-free rate. Risk-free rates go with currencies. There's a global growth rate, we can talk about that, but risk-free rates go with currencies. And finally, just because you have a government security doesn't mean you got a risk-free rate. Remember those 3 words I asked you to repeat every day for 10 days to rid you of this misconception? Anybody remember those 3 words? Come on. So memorable, I thought, when I gave them to you. Obviously not. This is all you need to do. If you're caught up in this notion that somehow because you have a government bond rate, you think it's risk-free, just say the word Greek government bond 10 times every night for 10 nights. And never again will you use the word government bond and risk-free as if they were interchangeable. Or if you don't like the Greeks, pick Venezuelan government bond. Or maybe Argentine government bond. I mean, let's face it, there are lots of governments where you're saying, I don't know whether I'll get paid. In fact, you've gone further than that. I'll never get paid. Just because you have a government bond doesn't mean you have a default-free rate. So I'm going to take you through a series of very simple tests on the risk-free rate. Because remember, we went through this in corporate finance, so you might remember some of it, but most of it is just common sense. So remember what I said, you need, for something to be risk-free, you've got to make sure there's no default risk and no reinvestment risk or close to no reinvestment risk. So I'll let you fudge on the second one. So here's my first question. Let's say you estimate cash flows forever, which actually is what we do in discounted cash flow evaluation. We don't do it forever, but we stop in year 10. What do we assume after that? That cash flows will go at 2% a year forever. So your cash flows go on and on and on. You need a discount rate, one discount rate to use on all of those cash flows. You're not a purist. And the cash flows are in US dollars. I'm going to list off potential rates you could use, and you can tell me with each one whether it meets your criteria, and if it doesn't, why not? Can I use a 3-month T-bill rate as my risk-free rate if I'm doing valuation? Which criteria do I fail? It's too short. I have cash flows forever. It's mismatching, right? It's duration mismatching. So the 3-month rate is off the table. Let's cross it out. There's a 10-year T-bond rate and the 30-year T-bond rate, and a TIPS rate. 3 treasury rates, right? Which of those 3 is off the table? You know what the TIPS rate is, right? Basically, you're guaranteed a rate, but then the inflation gets added. So you're given a 0.75% TIPS rate. In this case, 1%. You're guaranteed the 1%. Inflation is 5%. You get 1 plus 5. If it's 0, you get 1. So what kind of rate is that? That's a real risk-free rate, right? So the TIPS rate is off the table. So now you have the 10-year rate and the 30-year rate. If this was the only number you were estimating in your valuation, which is the better risk-free rate to use? Your cash flows go on forever. You want the longest term rate. Therefore, you should be using the 30-year rate, right? You're never going to see me use the 30-year rate in this class, and here's why. It's true, if all I had to do was estimate the risk-free rate, I'd go with the longest rate, the 30-year rate. But remember, there are all these other numbers I have to estimate, like what? Like I have to estimate default spreads on bonds. So if you're a company and I want corporate default spreads, how do I usually estimate default spreads? I find a corporate bond with the same maturity as a treasury, and I compare the two numbers, and I come up with a default spread. Do you see the hole I'm going to dig for myself if I make my risk-free rate a 30-year T-bond rate? Because then to get my default spreads, what do I need to find? 30-year corporates. That's much more difficult to do. Same thing with equity risk premiums. So I'm going to make a pragmatic choice. I'm going to go with the 10-year rate. It's not as good as the 30-year rate, but the nice thing about the 10-year rate is the rest of my estimation problems become a lot simpler, and use that as my risk-free rate. But in doing all of that, what am I implicitly assuming about the US Treasury? That it is default-free. This genie is out of the bottle already. 10 years ago, if you asked me if the US Treasury is default-free, I said, of course. Who's even asking questions about it? I don't know whether you remember in the summer of 2012 when S&P downgraded the US from AAA to AA+. Not a huge drop, but what they were saying is there's a glimmer of default risk here, and they got a lot of pushback on it. And they might have been wrong because the other ratings agencies did not join them, but at least the debate is open now. Can the US Treasury default? Yeah, I don't see why not. For the moment, I'm willing to assume that it's default-free, but I remain open to the possibility that I'm wrong, that 6 months from now I might have to revisit this. So I'm going to use the 10-year US T-bond rate as my risk-free rate because it's liquid, it's constantly traded, I can get a rate at every minute of every day, and it makes the rest of my estimation process easier. Any questions on risk-free rate in US dollars? So what's this number look like right now? Do you know? I think this is a number that, especially over the last 3 days, has been all over the place. End of Friday, it was 1.67%. Yesterday, it was 1.65. I don't know where it's now. But it's about between 1.6 and 1.7%. That's my risk-free rate in US dollars. Let's move forward. Slightly more difficult test. Something we tried in corporate finance. So maybe you remember the answer from corporate finance. I need a risk-free rate in euros now. So I moved on from the US dollar. This is January 1st of 2016. I looked up 10-year rates in euros. And the problem was I found not just one government bond, but a dozen government bonds, and the rates were all different, ranging from about 0.6% for the German euro bond to 9% for the Greek euro bond. I'm valuing a Greek company in euros. What's my risk-free rate in euros? Can I use the Greek government bond rate as my risk-free rate? I mean, we just said, you cannot say those words in the same sentence. It is definitely not risk-free. These are all in the same currency. This is not 1997. We have drachma bonds and French franc. These are all euro-denominated bonds. The only reason for difference is because the market perceives default risk in some European governments that it doesn't see in others. So what's the risk-free rate in euros? The German, not because it's German, but because it's the lowest of the 10-year rates right now. That number, you know what it looks like right now? It slipped below zero. It's minus 0.25%. File that away, because you can say, what the heck do we do about negative risk-free rates? We'll come back and deal with it. But you can already see that with euros, you had to take a step away from just using a government bond rate. So you can't use the French government bond rate to value a French company, because the French government, for better or worse, is perceived as having some default risk. Now let's make it tougher. I want a risk-free rate in Indian rupees. So I go look up a government bond rate. On January 1st of 2016, the Indian government bond rate was 7.73%. I'll send you a link to actually a great site that actually updates these 10-year rates in local currency bonds. You can't find it on Bloomberg. I looked, I couldn't find it. So I'll send you this link I found that updates these numbers on a daily basis. 7.73%. I'm home free, right? It should be my risk-free rate in rupees. But before I use it, what do I need to check? I need to check to see if the Indian rupee or the Indian government is default free. Now that's a tough question to get answered, right? You can't go around asking, do you think the Indian government is default free? So I cheated. I went to the Moody's website and I looked up the sovereign ratings for India. You're saying ratings? Why not? How come there are more than one? Because for every country that Moody's rates, it gives you two ratings. One is a local currency rating, the other is a foreign currency rating. The foreign currency rating for India measures how much risk Moody's sees in India when it borrows money in US dollars, Japanese yen, or euros. The local currency rating is the default risk that Moody's sees in India when India borrows in rupees. I hoped and prayed I'd see a AAA rating under the local currency rating, because then I could have gotten away using the 7.73% and blame Moody's if something went wrong. In this case, it turned out that they're a Baa3 rating. Not a horrible rating, but not AAA. So to the extent that I trust Moody's, which is not that much, it looks like they think there's some default risk in India. My task is laid out for me, right? Because then the 7.73% is not a risk-free rate, it's a risk-free rate plus some kind of default spread. So I came up with a default spread based on rating. And I'll take you through the process of how I come up with this every year, because I have a lookup table that I update every year. And the default spread I came up with based on that rating was 2.44%. You ready? So you have a government bond rate of 7.73% in Indian rupees. To the extent that you trust Moody's, there's a default spread of 2.44% that goes with India's local currency default risk. If I want a risk-free rate in Indian rupees, I'm going to give you some choice and you tell me which one you're going to latch on to. Can I stick with the 7.73%? And if I do, what's the problem I'm going to run into? I'm going to end up double counting risk. Do you see why I'm going to end up double counting risk? I'm going to end up using as a risk-free rate something that has a risk spread added to it. Then I'm going to get to the equity risk premium and I'm going to wake up to the fact that this is an Indian company and start punishing it with a bigger risk premium. You can't beat up a company twice for the same reason. So I cannot use 7.73. I'm going to assume none of you would pick B, because B, you're actually going in the wrong direction, right? You're triple counting risk. If you really want to punish India, this is the way to do it. No Indian company will ever pass muster. The right thing to do actually is to net out that 2.44% from the 7.73%, which leaves you with a risk-free rate in Indian rupees of 5.29%. I'm going to do this in Argentina on Friday. I'm going to do it in Chile tomorrow. And I always get pushback. Whenever I do this, any country, you know what the pushback is? There is no default risk in a local currency bond because the government can print more money. Sounds pretty reasonable, right? You're right, right? They're running. You know what my counter to that? You know that 1/3 of all sovereign defaults in the last 50 years have been local currency defaults. You know why it happens? Company's in serious fiscal trouble. It doesn't have the money to pay its sovereign debt. It has two choices, right? It can print money faster and pay off the debt, or it can default. Print the money. If you print the money, what's the cost you create? You basically debase your currency, right? And when you debase your currency, people stop trusting your currency. In what sense? For 10 years after Brazil had those 5,000% inflation rates in the early 90s, people would not buy long-term bonds denominated in nominal reais from anybody. Why? Because they'd been burnt, and they said, I'm not doing it. Why would I put a long-term bond in a rate and get burnt by it? So you have a choice. It's like between a rock and a hard place. A rock is, do you want to debase your currency and have people lose faith in the currency for the next 20 years, or do you want to default and get all the downside of default? And at least for a big chunk of these companies, the choice has been to default rather than to debase. So don't let anybody tell you, just because it's a local currency bond, there is no default risk because you can print it. That might technically be true, but lots of companies, lots of countries faced with that choice choose not to do it. So the big number here to get to a risk-free rate in a local currency then becomes coming up with that default spread for that country, right? So I'll give you 3 different ways in which you can come up with a default spread for a country. And we went through this in corporate finance as well, so it should be partial review. So you have a government bond rate in a currency. Then what's the default spread for this country? The first is, if you can find a US dollar denominated bond issued by that country or a euro bond issued by that country, you can back out the default spread from that bond. And here's how. For instance, if you take the Brazilian government, it has a dollar denominated bond. I can compare the dollar denominated bond to the T bond. That difference is the default spread for Brazil. I can do that because they're in the same currency. If I have a Polish government euro bond, I can compare that to the German euro bond and come up with the default spread for Poland. But this works only if your country issues bonds in dollars or euros or some currency where there's something risk-free. Doesn't work for India because India does not issue dollar-denominated bonds. They do not issue euro-denominated bonds. Here's your second choice, and this is a relatively recent one. You've heard of the sovereign CDS market. This is a market where you can buy insurance against default risk. It's kind of a market for default spreads. That's basically what it is. You can go to that market and look at what the spread is for your country. So this morning I downloaded the numbers. I'll actually put them up so you can download them for yourself and see what they look like right now. If you look at Pakistan right now, the CDS spread is 5.05%. What does that mean? To buy insurance against a Pakistan-issued government bond, you have to pay 5.05% each year out of whatever coupon you get on that bond. It's a default spread. It's a sovereign CDS spread. It's available for about 63 countries, but only 63 countries. Why only 63? There are 160 countries out there, or maybe more, 200 countries. So if you can get a sovereign CDS spread, that's your second choice. But let's say you have a country which does not have a dollar-denominated bond and does not have a CDS spread. You're up a creek without a paddle, right? This is when you get desperate. You go looking for a rating for the country, which is the Moody's rating. And then you go to the lookup table, which I created by using companies that I found in the first 2 groups. And based on what their spreads are and their ratings are, I've kind of come up with this lookup table. It's desperation time, but I'm going there because there's no other choice. 3 different ways of estimating it. Let me show you what the numbers would have looked like in January 2016. These are the local currency government bond rates. These are not risk-free rates in the different currencies for about 44 different currencies. So I'll just look them up. And you can, so let's pick a country. Let's pick Brazil. Brazilian real on December 31st, 2015 had a 16.51% interest rate. It's not the risk-free rate, it's a government bond rate. So what do I need to get a risk-free rate? I need a default spread for Brazil. Let's try the first choice. Sorry, the picture is so fuzzy, but this is from the FD every day. They have this emerging government bond rate. There's Brazil, and even if you can't read it, the Brazil 2021 bond on January 1st of 2016 had a 6.83% rate. This is a US dollar denominated bond issued by Brazil expiring or maturing in 2021. The 2021 US T-bond rate on that day was 2%. You subtract the risk-free rate, the 2% from this. So if I use the US dollar bond, the default spread for Brazil on January 1st of 2016 would have been 4.83%. So file that away. The dollar bond, The spread is 4.83%. I went to the sovereign CDS market on January 1st of 2016. There's Brazil, 5.58% CDS spread. Now, there's one thing about the sovereign CDS market that's a little messed up. You're buying insurance, but you're buying insurance from people with credit risk. So you know what I mean by credit risk? You can buy insurance, but if the person who's sold you the insurance goes out of business, your insurance falls apart. This is part of the reason the market almost fell apart in 2008, because one of the biggest sellers in the CDS market was Lehman. And when that left the table, people weren't sure the market would make it. It made it. You're saying, what are you going to do about it? There isn't a single country on this table with a zero sovereign CDS spread, right? The lowest, I think, is, the US was 0.39%. There might be 0.37% for the Netherlands. Nothing below that. So if I believe this table, there is no government with zero default risk. That might be true. Or it might be that what you're seeing here is a combination of what the default risk of the government is and the limitations of the market. Right? That there is some credit risk in here, and I've got to build it into the CDS spread. So you know what I did? I took the CDS spread I saw for each country and subtracted the US CDS spread from it. The rationale being that 0.37 or 0.39% that you see there is really not for default risk. It's really the limitation of the market. It's kind of a shortcut that I'm using. So if I subtract out the 0.39% from the 5.58%, my sovereign CDS spread for Brazil, adjusted for US CDS risk, is 5.19%. So right now I have two numbers for Brazil. 4.83% from the US dollar bond, 5.19% from the CDS spread. I'm not quite done. Brazil, I'm sorry, it keeps clicking around. Brazil at the time that I looked at, I think it was still BAA, yeah, it was a BAA3 rated country. So if I trust Moody's, Brazil's sovereign CDS spread, BAA3 is 2.44%. It actually got downgraded after January 1st of 2016, so it's actually now lower than it was. But on January 1st of 2016, it was still a BAA3 rated country, 2.44%. So if you ask me what the default spread is for Brazil, I'll give you three different numbers. It could be 4.83, it could be 5.19, it could be 2.44. This doesn't help me, because I get very different risk-free rates based on each one, right? The risk-free rate I get using the 2.44% is 14%. The risk-free rate, if I use the CDS or the dollar-denominated bond, is much lower. I'm going to say something that's going to sound absurd, but I'll back it up. It doesn't matter which default spread you end up using here, as long as you stay consistent using that spread everywhere else. You're saying, where else am I going to use it? You're going to use it to come up with an equity risk premium. So if you pick the small spread here, saying it's bad because it pushes up your risk-free rate, but it's going to help you on the equity risk premium piece. So my suggestion is, for your country, if you have to do this, pick one spread, make your choice, move on. Just stay with that spread all the way through your analysis. So I know we're at the end here, but I'll leave you with a final question, and I think this is fairly easy. Let's say you decide to go the real risk-free rate route. You know where I get real cash flows and I need real risk-free rate. Real risk-free rate is tough to find. But I did say the TIPS rate is a good measure of a real risk-free rate, right? So 0.75% was the January 1st, 2016 number. Let's say I have to do a real valuation in Argentina. Can I use the US TIPS rate as my real risk-free rate if I'm doing a real valuation in a different country? I'll tell you when you can get away with doing it. If you assume there's free flow of capital across markets, real risk-free rates have to converge across the world because money will leave the low risk-free rate market. But we know capital doesn't flow. I know the real risk-free rate in Argentina is going to be much higher than 0.75%. It's the nature of the process. But the reality is, if you do real valuation, you have to start with the TIPS rate and then ask the follow-up question, what do I do in this country? But when we come back on Monday, we're going to start with this question of what do we do about risk-free rates being as low as they are today and negative in some currencies. But I'll see you on Monday. if they allow you to take it back,
Okay. Okay, I'm just thinking, what else should I do? How to make the first two class? Like if
they're online. You can watch
the
both
syllabus?
classes. Syllabus, the webcast, the whole class is on.
Okay, cool. So I just kind of
So
go
first
somewhere.
register for the class
Okay.
and then go to the website for the class. So
Yeah.
go
Okay, is there anything really urgent I should do? Like,
everything will be on this. So as you read through the syllabus, it'll tell you what you need to do.
alright, thank you.
Hi, how are you?
I wanted to ask, I really wanted to see
The financials will be easier because not because they should be easy, but because often the path you have to verify these systems because there's so much you don't know yet. It's the evaluation. At the end of it, 80% is going to have to be based on the trust and the trust companies not holding it out. And that's always going to be the case. If I did JP Morgan, I would say the same thing. It's actually straightforward to do. So it's really relatively simple because we have income and cash flows and so basically. They're regulated, I assume, by somebody. Right? So,
I was the other companies I just have marketing services, have a private credit card company, but they're an industrial, so they're not right.
you don't want to go into the fintech space and do PayPal. I mean, that's the other thing. Is that's where the exciting things are happening is in financial services and technology coming together. So most of them are private.
Volunteer, but I don't think I can get them yet.
Private they're like the CIA. Nothing gets you.
Okay, then I'm going to look at it.
Look at fintech space because I think especially the older fintech companies, if you want something with substance to it, PayPal is a perfect company that captures kind of being there at the beginning but has potential for being part of this much bigger market.
Great, perfect.
Hey,
For the group project, the maximum is 8. So
you really can get away being 8. I'm okay.
yes, that's why I say
It's really, I mean, it's the challenge that becomes yours. Logistical challenge with 8 people, but you try to make sure the 8 people actually get done.
I don't understand the investment. You say revenue is revenue of the one and then divided by that.
Basically, I'm saying the sales to gap ratio measures how much for any given change in revenue they have to invest. That's all it is.
So it's just a ratio of the difference in revenue.
It's basically invested capital divided by sales.
What's capital?
The change in invested capital is reinvestment. So all I'm doing is I'm saying the invested capital in this company is 1/5 of revenues. If I'm going to increase my revenues 100 million, I've got to come up with 20 million invested capital.
So what is the difference between the revenue?
Because it's only the incremental amount.
Okay.
Right? It's a change.
Yeah.
So that's all it is. So the very simplistic way of doing things is like doing it the traditional route of capex and working capital is almost impossible to do because the company doesn't know what its capex is going to be. Right? And there's nothing of substance other than revenues to pay.